All right, let's dive into the State Bank of India. In this explainer, we're going to break down the investment case based on a recent equity research report. And they've got a pretty bold take, calling SBI a digital financial fortress. So what exactly is behind that powerful name? Let's find out. Okay, let's start with a headline that really got the market talking. On February 3rd, 2026, SBI stock hit a massive all-time high, 1,090 rupees. When you see a number like that, you've got to ask, right? What's driving this incredible run? And more importantly, can it last? So here's the thing. To really get what's happening with SBI, you have to throw out the old playbook. This isn't your grandfather's slow legacy public sector undertaking anymore. The whole story has shifted. The bank's gone through this huge digital pivot, and now it's playing the game like a modern digital-first financial powerhouse. All right, so let's get into the details. First up, we're going to look at the bull case, all the core reasons to be optimistic about SBI's future. The first pillar of strength, it's all about digital. And look at this. The YONO 2.0 app is an absolute beast. Analysts call it a digital moat, basically a huge competitive advantage that's tough for anyone else to cross. Get this, over 65% of new savings accounts are opened on this app. Think about that. It completely changes the game for customer acquisition costs. They don't have to rely on physical branches nearly as much. That is huge. Okay, next up, the balance sheet. The report calls it a fortress balance sheet, and honestly, that's not an exaggeration. The asset quality is the best it's been in a decade. Gross non-performing assets, the bad loans, have fallen below 1.8%. That is incredibly clean. And a healthy loan book like this is exactly what you need for stable profits, which is why we're seeing a solid return on assets of around 1.1%. So you've got this strong foundation, but what about growth? Where's the fuel coming from? Well, right here. They recently raised 25,000 crore rupees. That's a massive amount of dry powder, as they say in the business. It beefs up their capital ratios, and it means they are locked and loaded, ready to fund the next wave of credit growth, especially with all the big infrastructure projects on the horizon. Okay, so they have the money, but what's the plan? Management has this really smart two-part strategy: defense and extend. It's simple, really. Defense is all about protecting their biggest advantage, that huge base of low-cost CASA deposits, current and savings accounts. That's the cheapest money a bank can get. Then, extend is about using that advantage to push into areas with higher returns. Put them together, and that's how they're aiming for a solid 12 to 14% credit growth. So, is this strategy actually working? Well, the proof is in the pudding, right? Look at their profitability. We've been in this high interest rate world that's been squeezing a lot of banks, but SBI, their net interest margins have been incredibly tough, staying above that 3.0% mark. That tells you their execution is just rock solid. And here's the last, but maybe one of the most important parts of the bull case. SBI isn't just a bank anymore. It's a collection of powerful businesses. You've got SBI Life, SBI Mutual Fund, and then there's SBI Card, which just saw its profits jump by 45%. All these subsidiaries are unlocking massive value. So you can't just value SBI as one single bank. You have to do what's called a sum of the parts valuation to really understand its true worth. Okay, that's a pretty powerful bull case. But we've got to look at both sides of the coin. A good analysis is always balanced. So now, let's flip it around and dig into the bear case, the potential headwinds that could throw a wrench in the works. So what's the biggest worry? Well, it's a big picture, macro-level risk. The government has a huge borrowing target. We're talking 17.2 trillion rupees. When the government borrows that much, it can push up bond yields for everyone. And for a bank, higher bond yields mean their own cost of money goes up. That, plus the fierce competition for deposits, could start to squeeze those strong net interest margins we were just talking about. That's really the main risk on the radar. So there you have it. A strong bull case built on digital and a fortress balance sheet versus a bear case centered on macro risks. So, where does that leave us? Let's see what the final verdict from the analysts is. And a huge part of that verdict comes down to one thing: valuation. This is fascinating. Even after that incredible stock run, SBI still trades way cheaper than its private bank rivals. We're looking at a price-to-earnings ratio of around 12, while the other big players are up over 18. So the big question is, does SBI still deserve that discount? Well, according to this report, the answer is a firm no. They believe SBI has earned a new title, a definitive compounder. That's just another way of saying it's become a reliable, long-term growth machine. And the proof? A massive 215% return over the last 5 years. The argument is that this performance proves SBI has finally shaken off that old, discounted PSU label for good. And that brings us to the bottom line from the India Corp Insight 365 report. Now, I have to be really clear here. This is their conclusion, not financial advice from us. But they wrap it all up by saying that SBI is probably the safest big company bet you can make on India's overall economic growth. And because of that, they've given it a long-term buy recommendation.